Scott Ladner. Scott, you say that the markets are in a read and react situation. So how do you approach these headlines? And then take that back to what you heard from Kevin Hassett, 4 to 5% growth, and he is standing by that. He also said this morning that Jerome Powell will exit stage left in May.
Yeah, hey, Cheryl. Look, I mean, this is kind of a read and react moment for markets. This is not a place, frankly, where you can do a whole lot of forecasting and have much confidence that your forecast is going to be right, because things are moving so swiftly and at the whim of a couple of leaders, around the world. And so trying to forecast like kind of what is in those leaders' minds or kind of how this thing's going to end up playing out with any degree of confidence is really sort of a foolhardy game. So really, the way to play something like this is to have some battle plans, that's, pardon the pun, ready for your portfolio. Like whether we have this thing get extended, then we'll get extended, or whether we get a more quick ceasefire like we're hoping is going to stick right now. And just have, be able to move quickly into those types of positions as you see the news sort of hit. And as you see, frankly, the oil price react. And we're not looking at the front month oil price. We're looking at more longer term. You want to look at the oil price out a year or two also to help gauge like how persistent the market thinks this energy shock is going to be. But if you can play those types of games and you can be quick and do your homework ahead of time, this is the kind of market that can provide quite a lot of opportunities. As Mr. Hassett was saying, and with very strong economic growth that could be kind of coming back on the horizon if the ceasefire can hold.
Well, that's the thing, is that, there are many analysts and investors that have joined our network throughout the day today and yesterday saying this is where you look for opportunities. And when you have a market in particular that reacted the way that it did yesterday on a ceasefire, and a ceasefire headline that was a little bit shaky when the markets opened today, still this reaction to negotiations between Israel and Lebanon, all of that kind of factors into a market that is ready to rock. Is this the opportunity? Is this the day?
Look, if the ceasefire holds, it is absolutely the day for the market to start rocking again. But for that, because if that ceasefire holds, we have all these tailwinds that we had, 6 weeks ago. The thing we were talking about, Cheryl, was this massive amount of tailwinds that we had towards nominal GDP growth, not only in the United States but globally. You think about all the stimulus from the fiscal side. You think about stimulus coming from the Fed having cut rates over the last 12 to 18 months. Those rate cuts are just now hitting the economy. When you think about the transformative impact that AI can have on productivity and therefore company margins, which is really where it kind of hits the road for the stock market. There were just a massive amount of tailwinds coming into this year and coming into this, coming into the conflict. That if the conflict can be, rather short, and the thing that we're really looking at is how long is oil going to be above 80? If this thing can be rather short, those tailwinds can reassert themselves. And this is going to be an amazing buying opportunity for some of those more cyclically oriented types of companies that really rely on fast and increasing nominal GDP growth. But that's, the time under conflict really is sort of the key.
Well, you say nominal GDP to scream. I like the line you put down in your research, but you say technology, anything that's more U.S.-based opportunity, which I think makes sense here, and then some favorite internationals. You're pointing, though, to Latin America. I think that's key. I also want to kind of pivot to tomorrow morning because we are going to be getting March CPI. This is the first inflation read we're going to get since the war with Iraq began. Obviously, this is the month of March. We know this is going to be a rough report. We know that energy is going to be a major inflationary factor. If you strip that out, though, what are you looking for in CPI tomorrow for March?
We're looking at continued progress towards that the normalization of inflation that we've been seeing for the last couple of years. I mean, this is a slow, grinding inflation coming back to normal process. And not say the war is going to provide a hiccup towards that, especially on the headline side of things. But that that shouldn't really deter anybody. I mean, it's not a secret that we're going to have a hot headline CPI print tomorrow. Frankly, if we don't get one, that's going to be a surprise. But we're really looking for looking for the core. We're looking for the sort of the non-energy related types of inflation numbers, and we think we're going to continue to see slow but steady progress towards that towards the Fed's mandate. In doing no small part towards the productivity gains that the AI technology is really starting to provide. I mean, this is starting to impact how companies are behaving, it's starting to impact how things are being priced. It's a slow process, but we know how this plays out. We've seen the last big technology revolution back 25 years ago with the internet and this sort of deflationary impacts that had. This is the same kind of thing, but just on steroids.
Yeah, and to your point about AI and the job market, we're seeing productivity, but we're not seeing meaningful job losses. The AI story is playing out very different than what some of the bears out there had predicted. Scott Ladner, it's great to see you. Thank you for being on with us today. We really appreciate it.
Thanks, Cheryl.
All right, Scott Ladner.